Here's the exact step-by-step workflow you can follow from the first email to a complete cost plan. That's the promise of this lesson. But I want to zoom out and make it practical in a way most courses don't. How do you actually deliver cost-related service as a tax pro? Make real money doing it and avoid getting burned by penalties or bad studies. Because here's the reality. Tax prep is crowded. It's compliance, right? Clients shop on price. If you want your firm to stand out, you need real tax planning advisory. Cost segregation sits right in the middle of that, right? High impact, high dollar value, and high risk if you do it wrong. So in this video, I'm going to give you a very concrete 10 rules playbook that you can follow from. First is client email, screening and intake. Choosing which service to offer. Pricing and positioning. And then to partnering with engineers and to protecting yourself from the ass penalties. You can use this whether you are a solo EA, CPA, or a small firm owner, or a tax manager at the big practice. Let's start with rule number 1, decide your role. So rule 1, you are the strategist, not the engineer. The IRS cost segregation audit technique guide is very clear about what a quality cost seg study looks like. They list detailed engineering-based approaches at the top and the rule of thumb or purely accountant-driven approaches down at the bottom of the quality scale. On top of that, the IRS and professional group stress that whoever is doing the study should understand construction processes, building systems, and tax law classification, not just depreciation tables. So translation for you as a tax pro. You do not need to become a cost section engineer. You do not need to be the one breaking down electrical, mechanical finishes, and site work. Your highest value is in the screening which project makes sense. Your highest value is in the modeling the ROI, in coordinating with a specialized firm that does have engineers, and then weaving that result into a multi-year tax plan. So from day one, your policy is we advise, we model, we coordinate, and we integrate. We do not pretend to be structural engineers. That's one decision already lowers your risk and raises your value. Rule number 2, use a clear intake and screening process. When a client emails, like I brought a building, should we do cost seg? You don't want to freewheel it. You want a 5 to 10 question intake you can fire up immediately, covering property type, location, purchase price, project cost, and land allocation, place in service date, major improvement already done or planned, their income profile, their W2 business rental, REV, SDR status, whole exists and likely exists. Think about sale versus 1031. That's your go and no go filter. You also want a basic size threshold, so you are not burning time on marginal cases. Many firms and advisors suggest that properties under roughly 500K often don't justify a full study unless they are highly specialized, while 1 million plus properties are frequently strong candidates. So your workflow would be like client asks, you send the intake, you do a quick screening. Is it big enough, complex enough, and is it client tax situation strong enough to even talk about cost seg? No more email change that you have to customize every time. That's way a lot of time. Rule 3, build a simple feasibility ROI model. Once you have the intake, your next move is not let order a $10,000 study. Your next move is run it through a simple feasibility template. Here what real world number look like right now. For a 1 million commercial building, a good study is often reclassified 20 to 30% of the basic into shorter lives that can create first year tax saving in the ballpark of 40K to 60K, depend on rate and bonus rule. In 2025, under new Big Beautiful Bill rules, with 100% bonus back on qualified property, that first year hit can be even larger for the right assets. The template doesn't need to be perfect. It just needs to check the purchase price, project cost, apply reasonable short line percentage for that property type, apply current bonus rule and their marginal tax rate, and also spit out roughly how much extra deduction and cash saving might this create. Then you can say to that client, based on your number, it looks like a quality study would generate about X amount of extra first year deduction and roughly Y amount of tax saving. Study fees for property of your size are usually in the A to B range, and you are looking at roughly about X percentage of return if land, like the amount of saving in the return that it was all work out, right? So basically you give the client some estimates. That's advisory. That's how you justify the entire project. Rule number 4, be honest with study costs and use them to position your advisory fee. So let's talk actual market pricing right now. As of 2025-26 planning season, recent guidance from firms and specialty providers show residential rental under about $5 million often see engineering based study fee in the $3,000 to $6,000 range. Many commercial properties fall into $5,000 to $15K range depending on size complexity. Some sources show broader ranges around $5K to $25K plus for larger or complex property, with typical standard commercial jobs around $7K to $12K. And the ROI, a lot of firms openly market that a well-chosen study often return 4 times to 30 times the fee over the holding period. Here's why that matters for you. If an engineer-led study is about 7K to 10K project that saves the client 40K to 60 plus K in year 1, you absolutely should not treat your advisory work around that as a free extra bucks to a $800 return, right? You want to charge a flat planning fee to run the feasibility analysis and ROI modeling. You want to build a separate fee for coordinating the study and integrating the result. Or bundle cost planning into a broader annual advisory package. The point is, you anchor your client expectation around 10 of thousand in saving and a 5-figure study, not around your 1040 fee. Rule 5. Offer a simple menu of cost-related services. 1. Most tax pros think of cost as order a study or not, so that's too narrow. Instead, think of it a menu with different levels. So level 1, screening and education. Pair consulting or part of your planning package where you explain cost order, the exact info, and tell them if it's even worth exploring. Level 2 is feasibility and ROI modeling. You run your number through your template, compare it with or without cost and deliver a short memo or call with a high-level result and recommendation. Level 3, vendor selection and coordination. You help them choose a reputable engineering-based provider, coordinate the documents, monitor the timeline, and sanity check the draft report. Level 4, integration and multi-year planning. You bring the study into the return, model rep, STR implication, basis QBI, NOLs, sale or 1031 implication, and create a planning summary. Level 5, audit-ready documentation and ongoing review. You build and maintain the file, tie it to future return, and revisit the strategy when they refinance, improve, or sell. You might not offer all 5 levels in day 1, but this is the full landscape. And this is where you separate yourself from we just repair the return. Rule number 6, respect the penalty environment. Know what's actually at stake. So let's talk about penalty, right? Because this is where a lot of tax pros quietly ask, do I really want to be involved in cost seg at all? First, there is not a special cost segregation penalty section in the code. What happens in a bad the IRS audit that depreciation decide that classification or basic are wrong and adjust the returns. The taxpayer might owe additional tax, interest, and potentially an accuracy-related penalty, typically 20% under IRC Section 6662. If the repairer position were unreasonable and reckless, repairer penalty under IRC Section 6694 can also come into play. Current IRS guidance on repairer penalties say, for an unreasonable position, the penalty is the greater of 1,000 or 50% of the prep fee for that return. For willful and reckless conduct, it jumps to the greater of 5K or 75K of the prep fee. And there have been real-world cases where consultants tied to aggressive cost-seg work got hit with significant penalty and scrutiny, especially when studies did meet the quality standard outlined in the audit technique guide. So yes, the risk is real if you are assigning the return that rely on flimsy rule of thumb studies, doing DIY studies without engineering or solid documentation, or taking position that you can't defend with substantial authority. But that doesn't mean to stay away from cost segs. That means stay away from bad cost segs. Which brings us to the next rule. Rule number 7, only work with high quality engineering-based provider. The IRS Audit Technique Guide and multiple professional articles all hammer the same point. The strongest studies are engineering-based, tied to the actual drawing, specifications, and cost data, and clearly reconciled to the total project cost. Low quality study, especially DIY or spreadsheet-only jobs without engineering input, float to the bottom of the quality ranking and are far more likely to be challenged. Your policy should be something like this. Like, you would only recommend firms that use engineering or construction professional with your experience. You would expect a detailed audit-ready report that matches the IRS own quality criteria. You don't slap together your own study and call it engineering. This is where those 10 questions ask the cost partner style article are helpful to things like, you can ask, how many studies have you done in this industry? You can ask, do you do site visit? You can ask, what's your audit track record? You are not just protecting the client, you are protecting your own reputation and penalty exposure. Rule number 8, lock down your engagement letter and documentation. Next, how do you paper this, right? For each cost seg related engagement, your engagement letter should spell out your role, that you are advising and coordinating, not acting as the engineer of record. It should spell out the standard you are using, that you will rely on reputable third-party study that meet our expectation for a quality report. The engagement letter should state the fact that the tax benefit depend on their wider tax situation like rep, SDR status, passive rule, etc., which you will analyze but cannot fully guarantee. It also says the audit outcome are not guaranteed even with a quality study. On the documentation side, for each property, you want a neat file that includes in-text responses and your feasibility analysis, the study engagement and final report, your reconciliation of the study numbers to your fixed asset schedule, a brief planning memo, what year implemented, rep SDR assumption, how losses can be used, thoughts on recapture, and future sales 1031. Articles from cost seg and tax advisory firm repeatedly stress inadequate documentation drive audit risk and can lead to penalty and recapture. You want to be the opposite of that. The firm where everything is clearly documented and defendable. Rule number 9, treat cost segs as one piece of the bigger planning stack. If you start and we got a big deduction this year, you are leaving half of the value on the table. The better way to position yourself is that cost seg study is one part of your bigger strategy. That includes real estate professional status or SDR planning, so the loss is actually usable. QBI planning and interaction with 1099A. Section 179 based on bonus Quality firms frame cost seg not as a trick, but as part of a disciplined multi-year tax plan that what let you charge planning fee, not just prep fee. Rule number 10, don't sit on the sideline just to stay in your lane. After hearing about penalties and audit, some tax pro might think, maybe I should just avoid cost seg entirely. In my opinion, that's the wrong move. Here's why. The benefit, especially with the 100% bonus back in play, are simply too big for many clients to ignore. Your clients are seeing ads and webinars about cost seg everywhere. If you are not in the conversation, somebody else will be. Incorporating cost seg into your advisory, offering a powerful way to differentiate your firm from poor compliance shops. The key is not to do everything yourself. The key is you want to screen the client, screen the projects, and educate the client. You want to model the hour and explain when it makes sense to move forward with cost seg. You want to partner with strong engineering-based providers so you can have a list ready to work with your client. You want to integrate the result into a thoughtful multi-year tax plan. You want to keep your documentation airtight and your position reasonable to avoid repairer penalty. That's how you provide real value, charge accordingly, and still sleep at night. Let's wrap it up and tie it back to your day-to-day workflow. When that next email comes in, hey, I bought a building, should we do cost segregation? I want you to hear these 10 rules in your head. 1. I'm a strategist, not the engineer. 2. I use a standard intent to screen. 3. I run a quick feasibility ROI model. 4. I'm honest about study costs and use them to position my advisory fee. 5. I offer a clear menu of services around cost seg, not just yes or no. 6. I understand the penalty environment and avoid unreasonable positions. 7. I only work with high-quality engineering-based provider. 8. My engagement letters and documentation are tight. 9. I plug cost seg into a larger multi-year plan. 10. I don't sit on the sideline, I just stay in my lane. If you build your workflow around these ideas, cost segregation starts being a scary one-off thing you hope no one will ask about. And it's become one of the most valuable, high-margin, and defensible services your firm offers to investor, landlord, and business owners.